All right, welcome to The Explainer. Today, we're going to demystify two of finance's most powerful and maybe intimidating tools, futures and options. And look, I know they sound super complex, but they were actually invented to solve a problem that pretty much everyone has to deal with, from ancient farmers all the way to massive corporations. So, let's just dive right in.
So, let's start with a question. How do you agree on a price for something that you're not going to buy for another 6 months? I mean, think about it. Imagine you own a coffee shop. You know you're going to need beans in 6 months, but you're really worried the price is going to shoot through the roof. On the flip side, you've got the coffee farmer who's just terrified the price is going to totally crash right when it's time to harvest. It's that exact problem, right? That fear of the unknown future? Well, that's precisely why these tools were created.
Okay, so to deal with this, the market needed a way to tame the future. It needed some tools to manage the risk of these crazy price swings. And the story of how they figured it out is pretty much as old as business itself.
And this is not some new-fangled idea, not at all. It actually started thousands of years ago with farmers just making simple handshake deals. Then, fast forward to the 1800s, and those informal deals got standardized into actual contracts for things like grain. By the 1970s, it wasn't just about crops anymore. They started covering financial stuff like currencies. And today, wow, these markets cover basically everything, from stock indexes to oil, and they're pretty much the backbone of how we manage risk across the entire global economy. So let's take a look at that original tool, the one that started this whole thing.
All right, so here we go. Tool number 1, the futures contract. This is the bedrock, the original answer to that farmer's problem we talked about. And it's a really simple but incredibly powerful idea designed to do just one thing: get rid of uncertainty.
So, what is it exactly? At its core, a futures contract is just a promise. That's it. Two people agree to trade something at a set price on a specific date in the future. But, and this is the most important part, it is an obligation. Once you're in, you are locked in. There is no backing out.
Yeah, you can think of it like a super firm, ironclad, legally binding handshake. You agree on the price today for a deal that's going to happen months down the line. It doesn't matter if the market goes way up or way down, the deal is the deal, period.
Okay, let's go back to our coffee shop. The company and the grower, they sign a futures contract. Let's say the company agrees to buy 1,000 bags of coffee in 6 months at $150 a bag. Now, both of them are obligated. The company has to buy, and the grower has to sell at that price. It doesn't matter if the market price in 6 months is $200 or $100. The transaction happens at $150. Just like that. Price uncertainty? Poof! It's gone for both of them.
But, that obligation, it's really rigid, right? What if you want some flexibility? What if you want the choice to do something, but not the requirement? Well, that's where our second tool comes into play. The options contract.
So an options contract, it's a completely different animal. It gives you the right, but crucially, not the obligation to buy or sell something at a set price. All the power is in that one simple word: choice.
Now, of course, this choice isn't free. You have to pay a fee for it, which is called a premium. It's kind of like putting a deposit down on a house. You get the option to buy it at the price you agreed on, but if you change your mind, you can just walk away. You lose the deposit, sure, but you're never, ever forced to buy the house.
And options, they come in two main flavors. You've got a call option, which gives you the right to buy. You'd grab one of these if you're feeling optimistic, if you think the price is going to go up. Then you have a put option, which gives you the right to sell. You'd buy a put if you're thinking the price is probably headed down. Up or down, buy or sell. Simple as that.
Okay, so there we have it. Obligation versus choice. A locked-in deal versus the freedom to walk away. Let's really put these two powerful tools side by side and break down how they stack up. It's really tempting to think of these as basically the same thing, but they're not. Not even close. They are two totally different tools, meant for two totally different jobs. And choosing the right one, it depends entirely on what you're trying to accomplish. Okay, let's break this down. With a future, that obligation is mandatory. You have to do it. With an option, it's a right. That is the fundamental difference. Now, notice the upfront cost. For an option, you're paying that premium for the right to choose. But now look at that last row, risk. This is the real game changer. With a future, your potential profit or loss is theoretically unlimited. The price can just keep moving against you. But with an option that you buy, your risk is strictly limited. The absolute most you can ever lose is the premium you paid up front. That's it. It's the difference between having unlimited exposure and having a defined, capped risk.
So, you're probably wondering, with literally trillions of dollars flying around in these contracts every day, how does the whole system not just collapse if someone can't pay up? Well, let's pull back the curtain and look at the brilliant architecture that holds this entire thing together. This phrase right here, it perfectly captures the genius of this central entity called the clearinghouse. What the clearinghouse does is step right into the middle of every single trade. It becomes your buyer if you're trying to sell, and it becomes your seller if you're trying to buy. Its entire job is to guarantee the deal happens, no matter what. So the clearinghouse gets rid of what's called counterparty risk, which is just a fancy way of saying you're worried the person on the other side of your deal is going to flake on you. By guaranteeing every single contract, it provides the stability and the integrity that the whole market is built on. You can think of it as the system's ultimate financial bodyguard. So how does the clearinghouse actually prevent a disaster? Well, one of its most powerful tools, which is used for futures, is a process called mark-to-market. It's pretty clever. Instead of letting profits or losses just pile up for months on end, it settles the books every single day. All the gains and losses are squared up at the close of each trading session. Let me give you a quick example. Let's say you buy an oil future at $60 a barrel. If the price closes that day at $62, that $2 per barrel profit is put right into your account that same day. And if it fell to 58, well, that $2 loss would be taken out. See? This daily settlement prevents these huge, unmanageable losses from building up over time, and it's what keeps the entire system stable. So, after all that, it really comes back to a pretty simple choice, doesn't it? These aren't just abstract market tools. They're really just strategies for dealing with an uncertain world. Do you prefer to lock in a price with a firm commitment, or would you rather pay for the flexibility to change your mind? And that kind of leaves us with one final question to think about. When you face uncertainty in your own life, what do you value more? The certainty of a locked-in plan or the power of keeping your options